Hey, it's Trevor Sines again, co-owner of Michigan Mortgage Modification, and in this brief video I want to discuss the Making Home Affordable Loan Modification initiative put forth by the Obama administration. And this is some pretty good stuff for anybody that has a loan that is owned by Fannie Mae or Freddie Mac. For those of you that don't know, Fannie Mae and Freddie Mac are the investors that buy a lot of the loans that are originated. In fact, over 60% of all loans that are originated are owned by Fannie Mae or Freddie Mac. So 6 out of 10 people have a loan that's owned by Fannie Mae or Freddie Mac. Anyways, the initiative actually is pretty interesting. First things first, in order to qualify, you have to have some form of financial hardship that would ultimately lead to imminent default, meaning that right now, if you continue on the same course you're on, your payment stays the same, you will not be able to afford it, and eventually you'll get behind and eventually head into foreclosure, or you're currently behind. All right? And if you have some form of documentable hardship, and that could be loss of job, loss of hours, unemployment, divorce, medical bills, really depends on the situation, and we can help you decide whether you have a hardship or not. But anyways, this Making Home Affordable initiative has some great things in place. And what they do is they base everything off of your gross income. So you can ultimately qualify for a mortgage payment that is 31% of your gross income. All right? And that mortgage payment includes your property taxes, your homeowner's insurance, your principal and interest payment, and any homeowners association dues that you may have. Okay, which is pretty cool for some people. Some people that make a good amount of money, well, their mortgage payment might be less than 31% of their gross income. And if that's the case, well, then I wouldn't pursue the modification through the Obama administration. All right, but the way that they achieve the mortgage payment is pretty neat. They start with your interest rate. So if your mortgage payment right now is higher than 31% of your gross income, the first thing they're going to do to reduce it is to lower your interest rate down to as low as 2%. If they can't get to the number they need to get to there, then they're going to extend your term up to 40 years. Now, the next step they take is kind of interesting. Okay, the previous video we talked about principal forgiveness. Well, with the Making Home Affordable modification, they do what's called principal forbearance. And what that means is, let's say they've done everything they can do to lower your payment. They've gotten you a 2% interest rate and a 40-year term, and the payment is still too high to be 31%. What they will do is they will take off chunks of your principal balance, and it won't be amortized into the loan, or you won't be paying on it. However, it turns into what's called a balloon payment due when you either A, refinance, B, sell your property, or C, when your modification matures. The Making Home Affordable modification is a 5-year term, so the maturity date would be 5 years later. So essentially, if you did not sell your home or refinance your home in the next 5 years, when that modification matures, you're going to have a balloon payment due in the amount of whatever they took off of your principal balance for the principal forbearance. So the money that you owe, you still owe. It's just one big chunk, or a small chunk, depending on how much they had to take off your principal balance, that will be owed after the modification matures. Now, personally, I believe this is going to open up a whole new can of worms 5 years from now, because if the housing market does not correct itself, you will still have this principal balance or this forbeared principal due that you won't be able to pay because you'd have to come out of pocket to pay it. So they're going to have to find some way to roll that into the loan, or some way to set up a payment plan for that after the 5 years is up. But it's not really worth worrying about that at this point in time. First things first, your goal is to save your home from foreclosure, or to be able to afford to stay in your home. And if they have to do principal forbearance to get you there, well, I would accept that, because at least for the next 5 years, you're going to be sitting pretty with a nice mortgage payment. And again, at that point in time, 5 years down the road, there may be a lot of people that have principal forbearance loans due. And the government's really going to have to think about what they're going to do to handle that. But right now, they're just buying time. You know, the reason that it's for 5 years is because that ultimately they think in 5 years the housing market will recover, your home will be worth more, and you'll be able to refinance at that point in time and clear up the principal forbearance on top of allowing your loan to get into a fixed rate. So when it comes to the Making Home Affordable initiative, it's a good step in the right direction. It's going to help a lot of people save their home from foreclosure. And another great thing about that program is that any of the payments that you're behind will automatically be capitalized or added into your principal balance, so you don't have to come out of pocket and make those payments up, and your loan will be brought current. So for a couple reasons, that's very good. The first reason is credit scoring. Your credit score or will be your credit report will show that you're current after the modification takes effect, and every payment you make from that day forward, it will help improve your credit score. So ultimately, by the time the 5-year term of the modification is up, as long as you pay your bills on time, you'll have a good credit score. You'll be able to refinance into whatever the rates are at that point in time, and things could be hunky-dory in your situation. Now, if the housing market doesn't recover, well, they're going to have to relook at what they can do. Mind you, banks do not want to own your home. Investors don't want to own your home. They want to make money off of your monthly payments. So if they can work something out to keep you paying them monthly, where they can still earn some interest, they're going to be willing to do that, especially if your loan is owned by Fannie Mae or Freddie Mac, or even the government through an FHA or Ginnie Mae loan. So that's what I wanted to go over in this video, the Making Home Affordable initiative. Great program, a lot of opportunity out there for homeowners. And if you have any more questions about this, you can contact us at the office, 248-674-6457. You might even talk directly to me. And you really need to know if your loan is owned by Fannie Mae or Freddie Mac, and we can let you know that in a simple phone call. So if you have any questions or if you want to know more about this program, give us a call, 248-674-6457. And the next video in this series is basically going to discuss if you should or you should not pay a third-party company such as Michigan Mortgage Modification to help you with your modification. So have a great day, and I hope this video helped you out, and I hope you look forward to the next video in the series. Thanks a lot.